The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and this is our hour to talk taxes. We want to help you so that you pay the least amount of taxes, get the biggest refund possible, and all the twists and turns that are in the tax law. And join in studio with me is Chris Fabian this week. Hey, Chris.
Hello, Esther.
Hello, Christopher. Now, we tried to come up with a topic each week. Now, this week we're going to talk about unusual things and how their income and how they're taxed. Basically, all income is taxable unless it's specifically exempt. So many times people say, gee, do I have to pay taxes? Unless it's specifically exempt and you got the income, probably it's going to be taxable. So we're going to talk about that. But more than anything, what you have to say is really important to us. So our phone number here is 803-0930. 803-0930, star 930 on a cell phone. Our toll-free number is 1-800-616-9236. And if you want to text us, it's 3930. And I'm Esther Gulius from EG Tax. We got all of our offices open 9 to 9 today. We're closed on Sunday except for the mall at the McKinley Mall, and all next week 9 to 9 on Saturday, because this is like peak time. Everybody's getting their stuff. I know that the blizzard kind of slowed everybody up, and they had to dig out. And being alive is a lot more important than doing your taxes. So if you have any questions, 803-0930. 803-0930, star 930 on a cell phone. And Christopher, let's talk. Anything you want to talk about right now?
You were going to say it. You said your life is more important than dying. But with the IRS, they're going to get your money either way.
That's true. They're there at the coffin. No, I'm not kidding. We wanted to talk to you, but is there anything that's happening in your world?
No, just
it's really interesting as we go through and do all these tax returns. I was just talking to you coming into today, how about all these schedules? There's no continuity or flow. It used to make so much sense, page 1 and page 2 of the 1040. Now you got a section and another section and another section and an addendum and forms. And so it's just all chopped up. I had somebody email me yesterday and said, I just don't know where to put my rental property anymore because it isn't clear, you know?
Yep. Oh, I have people, so I can do my kids' return on a 1040 EZ.
There is no 1040.
There is no 1040 EZ anymore, and their jaws hit the ground.
Yeah.
And they're like, what am I supposed to do?
But there's 2 half sheets of paper and 6 addendums, right? I'll tell you. Anyway, if you have any questions, I don't even know if you've looked at the forms. I'm Esther Gulius, the tax lady from EG Tax. Our website is egtax.com. You can click on Ask the Tax Lady, and we'll answer your questions in the middle of the night. I will answer your questions.
And, you were saying how, people haven't gotten everything. If you're not sure, we have a great organizer on our website, whether you use us or not. That's there for you, the listeners. Print it up and go through your last year's return. See what 1099s, what W-2s, what investment income you had, and just do a checklist.
I had somebody the other day that said, oh, well, I don't have the unemployment and I forgot my password and you got to go online to get it from New York State. So what I'm going to do is just put it on next year. And I said, well, first of all, because she said, because I got 3 years to report it. And I said, well, first of all, you can hold up this year's refund because the federal government has a copy of your unemployment, and you don't want them to slow up your refund because you didn't do a complete and accurate return. And you can't put it on next year's. You'd have to amend this year's return to put it on if you did it next year.
Right. Then they could hit 25% negligent
penalty. Right. All right. Let's before we get to the phones again, 803-0930, 803-0930, star 930 cell phone. Let's talk about unusual income items. Gambling. Why is that unusual, Chris?
Because everybody goes, I can deduct my losses, possibly. And it's a lot harder this year to deduct them this year than in years past.
So on miscellaneous income, you got to put all your gambling income.
Correct.
And it is true, you get to subtract as an itemized deduction, the gambling losses. However, it's much more difficult this year in order to itemize because as a single person, it's $12,000. So if your gambling losses are $6,000 and you don't have a home and you interest and property taxes and large medical and some charity, you might not be able to itemize. So those gambling losses just go nowhere.
Yep.
Right?
Yeah.
So it is true gambling's taxable. You can take the loss, but many times the losses are not going to be deductible. So you just end up, except on and on New York State, you can take them.
Yep.
Right? Inheritances and gifts. A lot of people say, "Oh, if I give my kid money, how much do they have to pay?"
It depends. Well, on a gift, if you give them money, there is no tax.
That's exactly right. And if mom and dad give them over $15,000, then mom and dad just do a gift tax return. It adjusts their unified exclusion upon their death. And unless they are a gazillionaire, nobody's going to pay the taxes on a gift.
Right.
Right?
Right.
But an inheritance could or couldn't be taxable, right?
Right.
Depending upon what you inherit.
Correct. So if you inherit the checking account, that's just cash, tax-free.
Right.
You inherit the pension. That's
not so good because, well, it's great to get it, but unfortunately, somebody's got to pay taxes on it, on the pension, the annuity, the IRA, right?
Yep.
But what's really important, and this is, if you haven't listed a beneficiary on your pension plans, your IRAs, your annuities, make sure you put a note in your head today that on Monday you're going to add the beneficiaries, because otherwise, upon your death, what happens in the estate, it goes to the heir, who then loses an option of spreading it out over their life expectancy, spreading it out over 5 years, or taking it in a lump sum. They'd be forced to take it in a lump sum, right? If the estate inherits it, that's even worse because
39% tax.
Right, 39% taxes. So, okay, let's go to the phones. I'm Esther Gulias, the tax lady. 8030930, 8030930, star 930 on a cell phone, and we got Elaine. Hey, Elaine.
Hi, Esther. Next month I'll be 70 years old.
Okay.
And I have IRAs in 3 different banks.
Okay.
Do I need to take minimum distribution from each bank?
Well, you can. What you have to do is figure out what the minimum distribution is going to be total from all 3 different IRAs. So then you can take that one figure. So say it's supposed to be 1,000 at this one, 2,000 at B, and 2,000 at C. So that means you got to take $5,000 out of your IRAs. So you can take $5,000 out of one IRA, and that would cover all 3 of the IRAs.
And usually I suggest taking it out of the least producing investment. You know, take a look at if you're getting 3.5% or 5% and 1%, I would take the withdrawal from the 1%.
Yeah, one of the banks is only producing, like it's produced 0.5%.
Oh, my. Well, you know, anybody that's listening, if you have low-producing IRAs, you can roll over that IRA into a higher-yielding IRA. And I will tell you, the Pentagon Federal Credit Union is a great place to look. There are numbers of banks that have higher-yielding 3.5% IRAs, and so you can roll that over. And because your RMD is coming up when you're 70.5, you might want to roll that over to a higher yield and then take a look at taking the money out of the lowest yielding investment when you add everything and divide it by your divisor.
So you roll it over to a
higher yielding. Yeah, if you want to, are you electronic, Elaine? Do you have a computer?
No.
Okay, if you want to call us at 632-7886, I'll give you some banks and financial institutions that are yielding, fixed rate, 3.5 plus. Now they go out for 5 years, but I will tell you, if interest rates go to 12%, you might want to take a penalty and break them. But I will tell you, I've been very successful at having them go out 5 years. So, okay.
Are they FDIC?
If they're in a credit union, they're federally insured by the credit union, Federal Credit Union Association, and if it's in a bank, it's FDIC insured. So yes.
Mm-hmm. Okay, thank you.
All right, thank you. Bye-bye, dear. And of course, if you got a stockbroker that can do a better job, but many people, when they're a little older, they don't want to take the risk.
Right.
I'm Esther Gilius, the tax lady, 8030930, 8030930, star 930 on a cell phone. We're going to take a short break, and we'll be back with your questions on the other side.
Just like the white-winged dove sings a song, sounds like she's singing. Ooh, ooh.
Hey, this is Esther Gilius, the tax lady from EG Tax with Chris Fabian, and we're here on WBEN, and we want to help you with your taxes. All of our branch offices are open, and our corporate office that just moved to 1890 Colvin is open tonight. All offices till 9 o'clock. And all next week, 9 to 9. Next week, Saturday, 9 to 9. Tomorrow, the McKinley Mall is open during mall hours. And so if you need the best tax help, EG Tax wants to help you. Right, Chris?
Correct.
All right.
We're
Let
there
us
for it.
go to Bob. And again, 8030930, 8030930, star 930 on a cell phone. We'll go to Bob in Lancaster. Hey, Bob.
Yeah, hi, Esther. I have a question about my minimum distribution.
Yeah?
My minimum distribution should be $43.46, $4,346. And when I withdrew the money from the bank before the end of the year, somehow I inadvertently only took out $4,000 and change in the rough. So is there any way to make that right, because it's supposed to be done before December 31?
Okay, well,
Wait, did you say it from the Roth?
No, it's not from a Roth.
Okay,
Yeah.
it sounded like you
yeah.
said the word Roth.
Okay, so yes, there is something you can do. Chris, you want to tell him?
Right. There's a 5329 you can do, page 2, where you can request for
Beg for mercy.
Yes.
You
To
know.
get rid of the penalty on
Right.
the remaining $346.
Right.
Which
So
would
that'd be
$173.
Right.
And then you would have to take out that $346 now
Right.
with your 2019 minimum distribution by the end of the year. But did they do federal withholding?
Yes, so I should take out the amount that I didn't take.
No, so Bob, is it possible that you did take out the $43.46 and they took $346 in taxes, and what you got left was $4,000?
Oh, no, that's not what happened.
No, that's not.
Okay.
Okay, so like Chris says, you go to the 5329, page 2, and kind of beg for mercy. On the bottom there, it says that you're looking for an exception to the penalty, and you just say that the bank messed up and you're now taking out the extra $346 to rectify it.
Of change. What's the name of that form again?
5329.
5329. I think that solves my problem.
Okay, Bob?
Thank you very much.
You're welcome, sir.
Okay, bye-bye.
Bye-bye.
We like solving people's
We do
problems.
love solving problems. I'm Esther Gilius, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone. Love to hear what you have to say. We have a couple texts that, well, are they? Yeah, that's text. Yeah.
Text
Yeah.
questions. Yeah. New York State child credit. Has that gone up as opposed to 33%?
Of the federal credit. See, New York State's all law, the whole law, is based on 2017. In 2017, the maximum child tax credit was $1,000.
Right.
Right? Now it's $2,000, but New York State is ignoring 2008 on the federal, so they're going back to 2017, which would have been 33% of $1,000, which would be $330, and that's what it is.
Correct.
Right?
Yep. So
Okay.
New York State is the same.
Right. So again, if you want to text us, 3930, and then we got another one.
Are retiree health savings plans taxable? They weren't before.
So if you're taking the money out of a health savings account to pay for medical bills, it's tax free, as long as it's qualified medical bills.
Right,
Right.
right.
So, and again, in a text, you can't get much more than the question. Okay, let's go back again. 8030930, 8030930, star 930 on a cell phone. Other unusual income items, insurance claims and lawsuits. So I break my leg in a car smashes into my leg. I go to a lawyer, we sue, and we get personal injury. Is that taxable?
No, it is not.
It is not. But if I sue because you knocked down my fence in my backyard, and I sue and say that you hit my dog, and I get $5,000 from that, is that taxable?
No.
No.
I'm going, huh?
Yeah, I'm just saying many insurance claims are not taxable.
Right.
But many of them are.
Right. Like, so if someone hit your leg with a car and you got the $10,000 for pain and suffering, but then they had to give you $2,000 for lost wages.
Then that's different.
Right.
Lost wages is taxable.
Correct.
Right? So it all depends on the type of insurance claim you have, right?
Yep.
Next is scholarships. Are scholarships taxable? Maybe.
Maybe.
Right?
Maybe.
So if you're enrolled in a degree program and you're getting your tuition and fees paid, right?
Yep.
And you got a scholarship, is that taxable?
No, it is not.
But if they paid you for your housing,
Taxable.
right. So that's what a lot of times I'll be working with mom and dad, and they come in with their 1098T. The tuition was $5,000. The scholarship was $10,000. So the kid ends up with an extra $5,000 in taxable income,
Yep.
right?
Yep. Oh, and then what does that mean this year with the lovely tax change?
That means that they can pay kitty tax on it, right?
At the estate rate.
That's right,
And-
which would really hurt.
Yep.
Which would really hurt. So, okay, and then sick pay. Is sick pay taxable?
Yes, it is.
It is.
As long as it's a policy your work paid for.
That's right. If you paid for it, that's different. Social Security,
Possibly.
maybe. If half your Social Security added to your taxable income plus other non-taxable forms of income exceed $25,000 if you're single, $32,000 married joint, then that answer, if it's the answer divided by 2, that would show how much is taxable up to 85%,
Correct.
right? But if it's under that 25,000, under that 32,000, it's tax-free.
Correct.
Right. Okay. I'm Esther Golias, the tax lady from EG Tax. 8030930, 8030930, star 930 on the cell phone while I'm on this. VA benefits?
Tax free.
Right. Alimony?
Depends.
You are just so good, Chris. It does
depends
depend
on what year your
year.
divorce is.
Right.
Yep.
I had a lady that called me the other day and she said, I'm so excited because this year I don't have to pay taxes on my alimony. When did you get divorced? 20 years ago. You've been paying receiving alimony ever since? Yes. It's still taxable. She said, what do you mean? I heard you. You said it's not taxable. In divorces that are after 2018.
Yep.
Right?
Yep. So which means from January 1st on from this year.
Right.
The
So
alimony
let's go back to the phones. We got Elaine. Hi, Elaine. How can we help you?
Hi, I have a question. I have a relative that resided in Florida until July and sold his house and moved to Western New York for a new job.
Okay.
3 months later, they purchased a house in September. So my question is, are any of those moving expenses that they had to pay to move everything deductible?
Well, we're going to go back to Chris.
What?
Yes and no.
This is one of the unusual circumstances this year.
Right.
Were they part of the military?
No.
Then there's your answer.
No, but it's deductible on New York State,
On
though.
New York State. Yep,
right.
yep, yep.
So it's a yes and no. Not on the federal, deductible on New York State.
Okay. Do they have to do a Florida?
Well, Florida has no taxes.
Florida has no taxes.
Right. Florida has no taxes.
Okay. What about
Florida has no taxes, but New York has big taxes. So their moving expense into New York State is going to be deductible, not on the federal, but on the New York State return.
Okay, and what about like mileage and gas, car expenses?
Right. So they're going to look at a 3903. And I think does New York have something? They don't have a New York. But if you look at the federal 3903 from 2017, that will be a really good tool for them to know what's going to be deductible. So their mileage is going to be deductible, their moving van, their
Boxes,
hotel
their
on the way up, the boxes, any storage that they had for a short period of time, all of that's going to be deductible.
What about taxes and interest on both houses, the one in Florida and the one in Western New York?
Well, on their closing statement, they have paid taxes to the former owner, and that's going to be a potential itemized deduction, plus the taxes they paid in Florida adjusted for the person that bought their house who reimbursed them for property taxes. So the taxes, yes, are deductible, but there's a $10,000 cap on state and local income taxes and real estate taxes on the Schedule A.
Okay.
Okay?
Okay, thank you very much.
Thank you, dear.
Those questions just fit today's topic. Unusual.
Unusual. Well, that's true, because the whole tax law this year is pretty unusual. I mean, have you done a lot of New York's itemizing?
I have.
And yeah, it's unbelievable.
Yep.
The sad thing is they don't give you a lot of the New York State itemized thing doesn't give you a lot of room for these deductions. So I'm using federal forms and photostating them.
into it,
Yeah.
yep.
I'm Esther Gullius, the tax lady. 8030930, 8030930, star 930 on your cell phone. We'll be back on the other side with your questions. That Frank, he loves them rockin' songs, and I like it too. I love songs that get you going, right? I'm Esther Gullius, the tax lady from EG Tax. 8030930, 8030930, star 930 on a cell phone. We got another text that came in.
But
I haven't filed any taxes in over 10 years. I was in prison. Well, not everybody. I had a client the other day that came in, and she was with her dad. And her dad, I was doing his return, and she said, well, I don't have to file because I only got $5,000 in income. And I said, don't you have 3 kids living with you? And she said, yeah. But I had a bad year. And I said, well, you don't have to file, but you want to file. And she said, what do you mean? I said, you qualify for the earned income credit, and you qualify, part of your refund's going to go with the additional child tax credit. I mean, and she ended up with like $4,000 in refunds. So sometimes you don't have to file, but you want to file. Now, if you're in prison, you're not making any money.
There's no income.
But there are many people that are listening right now that have income from wages, and they say, I don't have to file. Or you say to your kids, you don't have to file. You made $3,000. You don't have to file. You want to file. You got money coming back, right?
Yep, definitely.
Okay. All right. Before I leave this, I want to go through a couple more things. Child support, is it taxable?
No.
No. How about debt cancellation?
Possibly.
Yeah, you're just this maybe
I'm a
kind of
possibly
person. Maybe. When is it taxable, Chris?
Taxable when you are solvent, meaning you have more assets than liabilities, and you just called Discover and said, hey, I'll give you $3,000 to close my $8,000 credit card account. And they would say, okay, well, that other $5,000 would be taxable.
Right. But if you had debt of, let's say, $80,000 and you have no assets. Many times people that are having debt problems, they have to go, they probably could qualify for bankruptcy. They would qualify for bankruptcy, but they have no assets or very little assets. When you, at the time of the debt cancellation, if you have more liabilities than you have assets, then that would mean that your debt cancellation is not taxable, right?
Right.
And so you do a Form 982. Right. So that's, and then we're going to talk about ministerial income here in a minute. 8030930, 8030930, star 930 on a cell phone. And we got Sally. Hey, Sally, how can we help you?
Esther, I'm confused on the RMD.
Okay.
Now, I have 2 IRAs in one bank.
Okay.
And 2 IRAs in another bank.
Okay.
Now, do I have to take taxes out of both accounts?
No.
All right, tell me what.
So you got 4 IRAs, right?
Yes, and 2.
So let's say one is $10,000, the other's $10,000, the other's $10,000, and the other's $10,000. So you have $40,000 in IRAs, right?
Right.
Pretend. So let's say you're 70 and a half. So you would divide the $40,000 by
27.4.
27.4, and the answer then is your required minimum distribution.
$1,500,
How much?
$1,500
approximately. All right, so that's what you would have to take out in 2019 out of one of your IRAs. You can take the fifth. You can do 1,500 divided by 4 if you want, but it makes it more complicated. Just take the $1,500 out of one of the IRAs, and I suggest the one that performs the worst.
Okay, so then I can take the money out of one bank without taking taxes out, right?
Oh yeah, you don't have to take the taxes out.
Well, that's why I was so confused.
Oh yeah, you don't have to withdraw. The thing is, many times people withdraw, take the taxes out because they don't want to pay at the end of the year, and so you really need to consider how much other income you have.
Well, Esther, let me just clarify now, and then I want to tell you. So for the 4 accounts, I'm going to divide it by 7.4.
That's exactly right.
It's the amount of tax.
Well, how old are you?
How old are you? Yeah.
Well, I'm 70 and a half this
Okay.
Right, you're perfect.
Good. So I'll divide it by that amount, and the amount that I get, that's the amount I take out of taxes out of the least amount.
Well, this is not the amount you're taking out of taxes. This is the amount you're taking out of the IRA.
Your withdrawal.
Your withdrawal is that answer. When you divide the total value of your IRAs by 27.4, the answer is the amount you have to withdraw, not in taxes. That's the amount of money you got to take out.
Esther, the 2 banks are telling me how much money I have to take out. They're telling me you have to take out
No.
amount.
See, they're just doing their due diligence and saying, Sally, you better take money out of your IRA because you're 70 and a half. You don't have to do what the bank says. You can take those 4 IRAs, add it together, divided by 27.4, and you can take that answer out of one of the 4 accounts. If you want. But if you want to do a little out of each one, you can do it that way too, whichever you prefer.
Okay, and then when do I take the taxes out of it?
Well, maybe you don't need to take the taxes. How much money do you think is going to be coming out of your IRA, Sally?
Well, according to the bank, I didn't know about this 27.4. The total for the 4 accounts from the 2 banks is $29,300.
Oh, okay. Well, I would take the taxes out at the time of the withdrawal. So I would take 10% taxes out, so $2,930.
Do you have any other income?
The $18,000 in Social Security.
Okay. So part of your Social Security is going to become taxable, but the 10%. Are you single or married?
Widowed.
Widow. So yeah, you're going to have like 1430. So you're going to have about 16,000 taxable at 10%. Yeah. So if she takes out the 10%, you're going to owe a little bit, maybe 20%. But if you want to know exactly, Sally, you can. You got a computer?
No, I don't.
Okay, but you can call us at 632-7886, and we'll work up how much you're supposed to take out, because you can actually owe next time on tax time, and there is an exception to penalty, but that means you might owe a couple $1,000s. It all depends on your own preference.
Okay, but may I question you? I want to do it the safest way.
Well, then I would take it out. At lumps. I'd take a lump sum, and I think I'd probably take out 20% because you got taxable Social Security as well.
Okay, I'll take 10% tax out of the 2 accounts in one bank, and in the other bank, 10% tax out of those.
Well, I think I was saying 20%, but because your Social Security is going to become taxable too. I think I'd do 20%.
Out of all 4 accounts then?
Collective, it's 20%. Yeah, 20% across the board.
20% across the board
Right.
on the total amount?
Right.
Okay, and then...
and then on the state of New York, you're going to owe some taxes as well.
Okay.
Very little.
Very little. So don't worry about New York.
Okay, but all above board, that's exactly then what I'll...
Okay, sweetie.
Oh, thank you so much.
All right. Thank you, Sally.
Bye-bye.
Bye-bye. I'm Esther Gulius, the tax lady, 8030930, 8030930, star 930. That's the cell phone. The other one says, Esther, you look good as a blonde. Okay, I tried them all. I've tried every color. You know, as you get older, it just gets tougher to glue yourself together. So tried them all. That's why we did that commercial, because we were sitting around and I was saying, you know, it's just so weird how taxes are like women changing their hairstyles and their colors. Everybody's always changing it, and it takes time to get used to it. And I thought, my gosh, that's just exactly like the tax law. Let's talk about ministers' income.
Okay.
So ministers are taxed completely different than everybody else, right? Pretty much.
Maybe.
Well, first of all, when a minister gets ordained, he or she have the right to, if they conscientiously object to being paid like
When
on the public dole, that you conscientiously object to receiving Social Security and public funds, they can make an election to be exempt from FICA.
Right.
Right? When they get ordained. So if that's the case, then they would pay income taxes on their wages. They would pay income taxes on their housing. They would pay income taxes on their wages, but their housing would be tax-free,
Yep.
and they would pay no FICA.
Right.
Correct?
Correct.
If they did not conscientiously object to receiving public funds, then their wages are taxable, their housing is not taxable, but both their wages and their housing is subject to FICA.
Correct.
Now, if they didn't spend all of their housing on housing, then part of the housing becomes taxable as well,
Yeah.
right?
Yep.
So if you're a minister and the other thing is you can also reduce your FICA as a minister by any non-reimbursed expenses that you incurred doing your ministry.
Right. Right.
So that's another thing. So many times when we see pastors, it's so difficult because they really have their own unique way of being taxed, right?
Yep.
Okay, I'm Esther Gulius, the tax lady, 8030930, 8030930, star 930 cell phone. I think we've never really talked about that on air, about the difference between minister taxes. Let's go to Tony. Hey, Tony, how can we help you, sir?
How you doing, Esther?
Good.
I was calling on behalf of my son. He's a first-year college student, and he always filled out the 10 Easy or 1040 Easy, and I was wondering, what does he do this year?
Well, he's got the 1040 form. He's got a file, but it's like 2 half sheets of paper and 6 potential, what do they call? They're called attachments.
Schedules.
Right, schedules. But how much did he make, Tony?
Probably a little over 10,000.
All right, so the first 12,000, if he has no other source of income, no unearned income.
No.
So the first 12,000 is going to be tax-free for him, okay?
On the federal.
On the federal. But on New York State?
The New York State, he's going to still owe tax.
Okay.
So because that standard deduction's like $35.
So it's just getting used to the new form. And you're going to claim, I'm assuming he's in college, so I'm assuming you're still claiming him as a dependent.
Yes.
And then he's under first 4 years of higher education?
He's actually in a 2-year program.
Okay, so you're going to take the American Opportunity Tax Credit, and he's going to get all his money back on the federal, and on the state he's going to pay a little liability.
Okay. So that's what he'll look for it under the 1040, but you'll fill all the schedules.
All those things, yeah. Okay?
Sounds good. Thank you.
All right, thank you, Tony.
All right.
I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone.
Yeah, kids are loving the federal this year because they get the higher standard deduction.
Right.
And that, usually they're like, oh, I have to take $10 out for the federal and $5 extra each paycheck. And now the federal, they're getting everything back.
Right, but on the state,
They're
same old.
Yep.
Okay, and then a lot of people are saying to me that there is no itemizing anymore, and that's not true at all, right?
No.
Now, I'm not saying that it isn't more difficult to itemize. It is. And the other thing is you might not itemize on the federal, but you might itemize on the state, right?
Yep.
So let's talk about things that are itemized. Medical.
Medical, still there. 7.5% floor limit.
Right. So all the medical insurance, doctors, dentists, in vitro fertilization, health insurance that you pay yourself, right?
Yep.
Even the off of your Social Security.
Yeah, your Medicare, your prescriptions, your dental, your eyeglasses, your braces for your kids, maybe even adults if you have braces.
Right.
All that counts.
Right. And your medical travel.
Yep.
And if you had to do any kind of a medical adaptation to your house, like let's say you're living in a 2-story house and you can't get upstairs, and you get one of those riding chairs, right?
Yep.
That's also a medical deduction. So your medical has to exceed 7.5% of your adjusted gross income. Taxes.
Your property taxes, your school, your county taxes count. Your withholdings from your pension from your jobs, that counts. Your estimated
on New York
tax
State, New York State withholding.
Right, your New York State.
Yeah.
Your estimated taxes to New York State.
Right, but they cap it at $10,000.
Correct.
Right, but the state of New York,
the state
no cap.
Yep.
Like I had a couple in today their property taxes was $16,000. We took the whole 16 on New York State, but on the federal we had to cap it at 10.
Yep.
Right?
You know, I just realized today when I was looking at the form, other personal taxes. So if you live in Virginia or North Carolina where they charge you
personal property,
personal property tax on your car, on your value, that gets added to the 10,000.
10,000, right.
So it's not the whole section gets capped at 10. You know, unfortunately, New York State, we don't really have any other taxes besides.
Right. Unfortunately.
Let's not give them any
Okay.
ideas.
All right. Then charity. Charity is still deductible, just like it always was. There's the two categories. There'd be cash and non-cash.
Right.
Right. So and you got to make sure. And then somebody else today emailed me and said, gee, how much am I allowed to take? You're not allowed to take anything. You got to be able to prove your charitable contributions. And if you're like a Meals on Wheels volunteer, you get the mileage.
Yep. You coach your kids' hockey team, football team, baseball team.
Right, as long as it's a not-for-profit.
As long as it's
right?
a not-for-profit, you're not getting paid.
So for charity, you get 14 cents a mile.
Yep.
And for medical, you get 18 cents a mile for travel related to that. And then if you give clothing to Goodwill or Salvation Army or one of those, make sure you do a detailed list. And I think you should take pictures.
It wouldn't hurt.
And don't just drop it off at the unattended center because you have no corroboration then.
Right.
Because you got to prove the deduction.
Yep.
Casualty law.
Wait.
I got to shut up. Yes, I forgot something.
You forgot interest.
Oh, thank you.
Because that's a big change.
That is a big change.
It's a huge change on this year's federal return. First of all, mortgage interests are capped at $750,000 on new houses, so you're only allowed mortgage interest up to $750,000 when you purchase a house. I know around in Buffalo there's not a lot,
Right.
but it still can come into play.
Right.
But the big thing is your home equity loans. So if you take out a home equity loan to pay off your credit cards, to pay your children's student loans,
Not deductible.
not deductible anymore.
On the federal.
But
deductible on New York State.
Correct.
It's interesting because now somebody will hand me their 1098 and I'll say, now this was for you to buy the house, right? Yes. And here I got my home equity. Tell me, was this for doing remodeling or repairs to your personal home? Yes. Okay, then we can take it. But if not, it's not deductible on the federal, but it is deductible in New York State.
Correct.
Right.
Yep. And people go, well, how are they going to catch that? We don't know yet. It could.
We
be,
don't know, but
it could
believe
be. You just get a letter in the mail saying,
Right.
"Please provide proof of your.
Right.
We see
What
your
you-
mortgage, and you have other interests. Please provide proof that was used for your house."
Exactly right. Exactly right. All right. So back to the charity, and then of course we have casualty losses. Somebody the other day said their house burned down and want to know how they can deduct it. You can't deduct it anymore in the federal, but you can deduct it on New York State because that would be a casualty loss if the incident was not due to your own wear and tear, any negligence on your part, and there was a sudden decrease in the fair market value of the asset, then that's a casualty loss. That's still deductible, and miscellaneous itemized deductions
Gone.
on the federal,
Yep.
but not on the state.
Yep.
I did an over-the-road trucker the other day, and he's 200 days on the road, and so we were able to deduct it on New York State.
Yeah. But how much did he lose on the federal?
He lost a lot of money. His refund went from $5,000 down to a balance due of $1,000.
Yeah.
So, what can you do? And I tell these people, why don't we talk to your employer to see if we can't help to modify the reimbursement policy so you don't get so, but, what can you do? I'm Esther Golias, the tax lady from EG Tax. We have 30 area offices to serve you. We're open tonight till 9 o'clock. You can call and make your appointments. You can walk in. We will take care of you. And we're going to go to the phones and talk to Marie. Hi, Marie. How can we help you?
Well, I have two Roth IRA or Roth accounts.
Yeah.
And I took money out of one and deposited it into the other one.
Okay.
And the check was made out to me, and I took it to the second institution. I got a 1099-R in the mail, and they're calling the withdrawal a gross distribution.
In box 7.
In box 7, what's the code?
Q, it looks like.
And you know what that means?
No.
It means it's a distribution from a Roth and it's not taxable. You've had it in there. You're over the age of
59
and a half, Marie?
Yes.
And how long have you had that Roth opened?
Oh, it was open for probably 7 or 8.
Okay, so you're good. So that 1099R, which says it's a Q, means that you took it out of a Roth, and that means it's not taxable. So you're not going to tax yourself on it. Now, when you say that you took it to the other bank, did you deposit it in another Roth? Did you take that Roth and put it in the other Roth?
I combined it so that I just have one at one bank instead of having 2.
Okay. So you did it right away, right?
An indirect
you did
rollover.
it. You did an indirect rollover.
Yeah, it was
Right.
a couple of days.
All right. So what you want to do is keep track of that, because the Q means it's not taxable, but the IRS is going to assume that money was taken out rather than rolled over. So, but remember, in a Roth, you aren't obligated to withdraw any money at any point in time anyway.
Right, but she may get a letter if they put it as a contribution that she wasn't eligible to contribute to her Roth IRA, where you may eventually next year get a letter and you'll have to say, no, it was a rollover,
that's true.
and send in all the proof.
Right. You want to make sure that you have proof, because in an indirect rollover, they may think that you had made a fresh contribution to the Roth, and if you were not working, you wouldn't have been entitled to do that. So if you ever get a problem, just give us a call. We'll help you. Okay, Marie?
Thank you.
Thank you, dear. Bye-bye.
Bye.
Yeah, and that's the thing. People don't realize when they do different things, it may not impact them now, but a year from now, and if they don't save anything, there's nothing you can do.
Yeah, and many times you go back to the financial institution, and they say, I don't know.
Yeah.
I don't know. All right. Well, basically right now, anybody that's confused, when you take a look at the new tax forms, they are completely different. New York State looks the same.
Sort of. We have page 1 through 5.
Right. But basically, New York law is all based on 2017. The federal law is all this completely changed format. Basically, all income is the same. All adjustments are the same. The itemized deductions are the major thing that's been changed, and the business pass-through.
Right, the QBI, which
Right.
we didn't even talk about today.
Right, that is true. And so if you're self-employed and you have a net profit on your business, then you have a and it's a qualified business, and there's some income limitations, then 20% write-off is also going to be a deduction. But if you need the best help during the tax season, EG Tax is open, like I said, 9 to 9 today, 9 to 5, 9 to 9 Monday through Friday next week, 9 to 9 on Saturday. And if you need help on Sunday, the McKinley Mall is open. And until next week, I'm Esther Gulius with Christopher Fabian.
Yep.
We'll talk to you later. Bye-bye.